Thank you for having us. Welcome panel. A lot to discuss. We're going to stick to time. We made that bet, so we're going to stick to it. And the conversation is really going to focus on the greatest opportunities that these panelists see for this upcoming year. And on that note, I do want to start with Secretary Mnuchin and give us your assessment of the current state of the U.S. economy, and then if you want to expand globally from there.
Great. Well, it's great to be here with everybody and see this fabulous turnout. I think the U.S. economy has done better than most people would have expected over the last year, despite the fact that we've had high interest rates. And I think really for several reasons. First of all, we're still feeling the effects of large fiscal spending. I think the long-term impacts of this and the deficits that the U.S. government is running is providing tremendous stimulus to the economy. So despite the fact that the Fed has raised rates, I think kind of that's why the economy has performed well. I'd say the second thing is, more recently, all of a sudden there's become, and again, it's changed again, the expectation of how quickly will the Fed lower interest rates and can they navigate a soft landing. I think the Federal Reserve was late to raise interest rates, and I think they're going to be cautious. I think coming out of the last meeting, there was kind of a lot of optimism that rates are going to go down. I think now it's a little bit more cautious. But I think the issue of the timing is almost less important. I mean, my expectation is that short-term rates stabilize around 3.5% when we get back down to 2 to 2.5% inflation. And even with short-term rates at 3.5%, I think the 10-year is probably still in the 4 to 4.5% range. And I think you're going to see a positive yield curve, again, given the large amount of supply of borrowings. So I think we're going to be with higher long-term rates. I think there's parts of the economy, particularly like housing, that impacts a lot. There were some discussions this morning. Obviously, anybody who's in a low mortgage is not moving. But, so I think it's going to be a cautious investment opportunity over the next year, particularly as we've talked about the political landscape, 2 wars going on, and the impact of the equity markets, particularly being driven by these 7 stocks with very high valuations.
And Fed Chair Powell reiterated that he's in no rush to cut rates anytime soon. People were anticipating perhaps March. Now it's looking perhaps June. Globally, can you expand your assessment? Obviously, we've got 2 hot wars going on, a lot of geopolitical uncertainty. How's Asia, how's Europe looking from your perspective?
Well, I really like the U.S. economy still on a relative basis to everything else. I think the U.S. is still, over a 5 or 10 year tremendous opportunities. We've had a lot of discussions on AI this morning. I think for legacy companies, it's going to be a huge cost-cutting opportunity, and that so many jobs are just going to be replaced with AI. I think also the other impact of AI we're going to see is the economic model of AI, because it's very, very expensive, as people have talked about, to run, and the energy consumption that it's going to use. But I do think the longer-term impacts in the U.S., I really like legacy businesses in the transformation. I think on a global basis, one of the really interesting things, everybody, at least for the last 5 years, when I was in government, the big question was, what's going to happen with China? Are they going to overtake the U.S. economy? And people were running all these numbers. You're going to see in China the population decrease significantly. I mean, most people think it's hundreds of millions of people, and you're going to see India grow substantially. So, I think the impact that for China, with already a weak economy, is going to be very expensive with the aging of the population. And, I think, broadly in the Mideast, particularly, around energy and energy transformation, I think there's going to be a lot of opportunities.
Dan, Goldman Sachs Research sent out its global 2024 outlook back in November, and then the headline was, "The hard part is over. Rate hikes have already delivered their biggest hits to GDP growth. We now estimate the global GDP will grow 2.7% this year. The U.S. is on track for growth 2.4%. Central banks, meanwhile, will have room to reduce interest rates if they're concerned about the economy slowing. This is an important insurance policy against a recession, Jan Hatzius wrote. Does that view still
Very
hold?
eloquently put. He's very good at what he does.
So I'll move on to the next question. I'm kidding. Does that view still hold, especially given some of the only increase in geopolitical uncertainty that we've seen?
It does still hold. And you give me a good entree to give a shout out to Jan. I will say, if we had all been here, or at least I'll speak for myself. I won't malign my co-panelists. But if we had all been here last year and tried to predict what it would feel like sitting here this year, I think we would have. My guess is we would have all talked about a hard landing. And the only person that I heard out there being very loud and talking about something different was Jan Hatzius from the outset. And we would have talked about a hard landing because we were battling the demons of 8 or 9% inflation. There was a I think correct view that the Fed would have to raise rates dramatically. You'd probably have to throw the economy into a recession by doing that to be able to tame that inflation beast. And yet here we sit again. The lone voice, or at least the lone voice I listened to, was Jan throughout that, expressing what he basically expressed there, and staying very steadfast and steady in that. And what we've had since then is 6% nominal GDP growth for some of the reasons that Stephen talked about. A consumer that stayed pretty healthy. I'm talking now from a U.S. perspective. As goes the U.S. consumer, so goes the economy, and unemployment's remained low. Wages have stayed relatively high. We have a once in a generation, maybe once in human history, emergence of a platform in AI that can drive productivity and growth. You've got rates, as Stephen alluded to, that went up a lot, but now feel like they're at a level where the only debate is how far do they come down and when do they start coming down. And that's always good for risk assets. And lo and behold, here we sit with stocks at all-time highs. And so when you put it all together, I certainly, if I had been here last year, I wouldn't have had the clarity of or eloquence of Jan Hatzius, or certainly the confidence
John's getting a lot of
Jan
shout-outs.
Hatzius. But I think he's right, and I don't think it's changed from our perspective.
Jim, you've been nodding your head. You tend to agree.
Yeah. It's interesting. A lot of points were brought up very calmly, very clearly, and the markets haven't had that calm and clear response to it. If we were to go back to October, and it varied throughout the fourth quarter, but continued through early January, the expectation was a hard landing. And, I think we'd peaked at expectations of 7 to 8 rate cuts over a 12-month period. We've dialed it down. I think generically most research firms, including ours, have dialed it back to 3, potentially 4. And one of the things that is really difficult, and I think the Secretary alluded to it, the Fed has monetary policy. There's been fiscal stimulus in many forms. And at the same time, the low rates that were experienced during COVID were incredibly beneficial for both the consumer and for corporates. The numbers are something like 70% of U.S. homeowners have a mortgage, and 70% of them, roughly, have fixed-rate mortgages, which they took out during a low-rate environment. If you look at investment-grade corporates in the U.S., it's similar in the sense that they issued about 70% of their debt was issued during that low-rate environment. So the couple of years prior to COVID and then during COVID. So if you look at what the Fed having monetary policy, and I'm not defending what they've done or at the speed at which they're doing it, but it's a challenge. The consumer would usually be the most negatively impacted with higher rates, with mortgage rates going up. That hasn't been the impact to them. Corporations, since they borrowed longer as well, they haven't had as much of that negative impact. And then, the other side of that equation is if you do have cash, it's the highest earnings you've had on that cash, whether you're a corporate or a consumer, in the better part of 20 years. So it's a very complex situation, and much of this is not as readily observable as, what the Fed funds rate is today. And I think, if we get into the various stimulus programs that are just in their infancy, they've been announced, but much of the spending hasn't been done. Whether that's the Inflation Reduction Act, the CHIPS Act here in the U.S., the European Union has its own policies that they've implemented and they're debating. So I think it's going to be uncertain on this path for growth and inflation for the foreseeable future.
So given that, and given that you said a lot of these programs are still in their infancy, what are some areas for potential growth that you're advising clients on?
Yeah, and the Secretary alluded to it, and Dan did modestly as well. Energy transition is still at the forefront. And I think one of the things that's the most interesting about it is the amount of dollars that need to be invested for these projects to be completed. So there are many people talking about AI and biotech, and I'll leave that to those experts, and it's been discussed prior to this panel. But if you look at it for 2023, I think the number somewhere around $1.8 trillion has been spent, broadly defined energy transition. So you're talking about renewable energy projects, you're talking about electric, broadly defined transport, so cars, trucks, charging stations, those types of things. And the third largest category being the grid, an upgrade of the grid. So, and then in addition to the $1.8 trillion, there was about $900 billion of refinancings or $800 billion of refinancings within that broader space. So, I mean, these are incredibly large numbers. Then you get into infrastructure broadly, and that's a global number, obviously. Bringing it back to the U.S., U.S. infrastructure spend alone is anticipated to be $2 trillion over the next 10 years. So these are large dollar amounts to be invested, long-term investing, and given the fact that interest rates are no longer zero, I think for the first time in the last handful of years, there's more rational pricing of risk, which I think is incredibly beneficial for investors.
Jerry, if I can turn to you and give us the Saudi perspective on the overall global economy and investment structure at this point.
It's a pleasure to be here, Bianna. Thank you very much. I think Saudi's always been in the conversation when people are trying to understand cyclicality, supply-demand, balance of energy. But there are long-term structural changes that are happening now, which are, I think, very important for investors to understand. If you take a 5, 10-year and beyond time horizon. I'll mention 3 of those. The first is industrialization of the economy. The second is the build-out of service sectors. And then the third is the impact of becoming surplus in green energy. On the industrialization side, the objective is to onshore manufacturing capacity in areas where the kingdom can be competitive and has a large import bill. And in some cases where it makes sense, build out export businesses as well. So we're seeing that in the construction value chain, metals and mining, consumer goods, and also in advanced manufacturing like automotive and aerospace and defense. And just in the past 6 years, one of my fans. So we've had 16 companies that have been established to fill gaps in these sectors. More than $88 billion has been deployed so far. And the objective of those is really to catalyze supply chains. So there's more than 70 advanced conversations going on right now with supply chain partners. In the service economy, for a variety of reasons, there were subscale sectors in entertainment, tourism, the sports, creative arts, but also sort of niche healthcare and educational offerings. And so citizens would often spend money abroad to receive those services. And so there's a large push to build out sectors that can serve the needs of citizens and residents, but also attract external demand into those sectors. I'll give you one interesting example that I think shows the full cycle from kind of objective to policy to financial returns. So about 6 years ago, a major push by the government was launched to get people exercising more and have a more healthy lifestyle. During that time, we've had a 3.5x increase in the number of people exercising on a weekly basis. The number of fitness centers has grown 13x. The contribution of that sector to the economy has doubled. And it's actually something you can invest in. So the first gym company that was listed in 2018 is up 4 times. And that was previously a private equity investment from 2013 by a leading private equity investor who helped focus it and grow it. So there are interesting opportunities that are being created by these various government initiatives. And then the third long-term structural trend, which His Excellency the Governor mentioned earlier, is building out green energy capacity. So if you think about the impact on the global manufacturing footprint, if you have a country that has land, that has advantaged logistics, and that is long in green energy, it creates a very interesting value proposition in sectors that are energy intensive and that are serving markets that are demanding greener inputs like Europe. So you could easily imagine, metals and mining, a variety of kind of heavy industry locating over time. It's also, I told my team I would make sure to mention AI at least once on this panel. It also creates an interesting opportunity about data centers, which are effectively a way to export green energy. So a lot of things are happening that I think investors over a longer term should be paying attention to, not just in terms of opportunities to deploy capital, but also, I think really importantly, is opportunities for their portfolio companies to grow.
Yeah, if I could just stay with you, and the Kingdom is halfway through Vision 2030. You've given us just some information as to how the diversification in investment has been going thus far. PIF has spent $32 billion across 49 acquisitions and other deals. The Wall Street Journal had a piece out this week that says to fill the gaps, the Kingdom has turned to borrowing, something it has shunned in the past. Can you give us more insight into that strategy and what it says about the future investments in some of the projects you have planned?
So Vision 2030 is the kind of the blueprint for this economic transformation. And it is a national project, but it requires global resource. It requires global talent, operating capability and capacity, and capital. And so the attraction of those into the Kingdom is embedded in the blueprint. It's very much part of the plan. The most effective allocators of that are really the investment community. And so I think in a way, the question about what happens next is really a function of whether people in this room and in rooms like this are learning more and trying to understand what's happening there. Personally, I'm optimistic. I think there's a growing awareness, we were just talking about this backstage, of the opportunities that are being created. I also think there are changes in the investment industry that are working in our favor. And I'll just mention two of those. The first is investment talent has been atomized. It's distributed much more broadly than it was, let's say, 20 years ago. And every one of those investors is looking to differentiate themselves. And one of the ways you can differentiate yourself is you find opportunities that other people can't. And you also try to create value that other people aren't. And that links to the second thing that's happening, which is there's a class of investors that are getting more demanding. And certainly sovereign wealth funds from resource-rich companies that are developing their economies is I think, central to that. And so the shift in a way from give us investment returns as a product to help us capture strategic value as a service is changing the dialogue that we're having with our managers. And that's encouraging them to understand the opportunities better. And I think when the global capital allocator machine identifies an opportunity and validates that, you get a flywheel effect. And I think we're in the early stages of that now.
Dan, if I could stay in the region, we mentioned there are two hot wars happening now in the world. A lot of concern and focus on what's happening, Yemen in particular, and the Houthis continuing to target cargo ships. I spoke with an expert who says they believe that this may likely continue even if things quiet down in Gaza, because this has proven to be, quote unquote, a success for the Houthis. In terms of what this could do for supply chain disruptions, concerns about longer term implications, if you want to weigh in on how Goldman's looking at that and how it could impact investors.
Sure. I think it's interesting from a business perspective, as someone who advises CEOs and CFOs on corporate transactions, so tries to essentially translate these macroeconomic views to actual practical business issues. While these geopolitical issues are horrific human tragedy stories, and the outlook for them can make you very depressed as you look at these things become simmering hot wars. So far, from an economic point of view, the economics that we've been talking about thus far with rates and growth and AI and innovation and everything else has been carrying the day in terms of impact on clients and impacting client activity more so than the anxieties around these geopolitical events. Each of these things meaningfully increases the tail risk that you have to assess when you're looking at corporate actions, whether that's M&A or capital raising or anything else. But as it relates to changing corporate activity, it's really the economic outcomes and the economic environment that has been dictating behavior more so than the geopolitical tensions.
Secretary, I was struck by comments you made. I believe you visited Israel not so long ago. You said you're looking at some very large, significant investment opportunities in the country. You said that the tech sector in particular and the outlook of the local economy you remain largely optimistic about. You want to add some more to those insights?
No, I think, look, Israel's been a really interesting hub for the creation of technology. Part of the reason for that is a lot of people come out of the military and are basically able to create businesses around that technology. But I do want to just go back and, you commented on the Houthis, and I know Secretary Pompeo will probably comment on this later. One of the things we worked on very significantly were the Iran sanctions. And they were having a big impact. And I think as you look at what's going on now with the fact that Iran is selling a lot of oil and evading the U.S. sanctions, that they're not being enforced, I think is a really big problem in the region. I mean, the Houthis have been a big problem for its neighbors, I mean, particularly Saudi Arabia. And now all of a sudden we're seeing a very dangerous situation where you're seeing sophisticated military equipment being used against U.S. ships and U.S. soldiers. So, I think Iran is the bigger problem in the region.
So what's the solution?
I think the solution is,
sanctions?
First of all, the sanctions need to be enforced. I think, second of all, there needs to be a global acknowledgement that we can never let Iran get a nuclear weapon if this is what we're seeing. And again, if you look at a lot of what's going on with Hezbollah, or if you look what's going on in Gaza, or you look what's going on in Yemen, this all points back to Iran. And, this is a pretty significant issue that I think has both economic and geopolitical events.
Dan, if I could turn to you and increased expected surge in M&A activity, what sectors do you think we should anticipate we'll see the most consolidations in going forward? And then Jim, I'll have you weigh in as well.
Yeah, I'd say I'm extremely bullish about the M&A outlook. I'm inclined to be, but I am sincerely and authentically. We're coming off of a 10-year low in announced M&A volume last year, which a 10-year low for an economy that is this big and this healthy and this dynamic is an unnatural low. And it was low because rates were going from 0 to 500 basis points. It was low because there was great dissent or disagreement on the outlook, and so it was hard to get people to agree and narrow a bid-ask spread and get people to agree on price. But I now sit here today, and I think the conditions for M&A are about as ripe and as good and as healthy as I've ever seen. And there are 3 or 4 things I'd mention. One is, in a slow growth world, and that's what we're talking about, we didn't fall into recession, but it's a pretty sluggish growth outlook out there. Every CEO that I've met, you'll rarely meet a CEO who doesn't want to grow their business. Mm-hmm. And so to grow in a low growth world, you often look to do things inorganically through M&A. I think it's also a world, as every single panelist has discussed AI and tech investment and what is required. It's a world where you need scale to make that type of tech investment. I look at Goldman Sachs, we're a $130 billion market cap company. I can't imagine being smaller because we have billions of dollars we need to invest in technology to keep up. So this need for growth, this need for scale. 1 out of 6 S&P 500 companies has an activist in the stock. These are investors who take a stake and agitate to act, and so that is a catalyst. for activity. And then you have financial sponsors, many of whom are in the crowd, who own $3+ trillion of assets to sell and have $2+ trillion of money to put to work. And so that is bound to be a catalyst for activity. And so to your question specifically on sectors, I see a big uplift, but I see it kind of across the board. Those trends, those thematics, those underpinnings that I just talked about are true across the board. What you do tend to see is once an industry starts to go and starts to consolidate, it builds on itself. So energy, for example, we saw a Pioneer deal, then a Hess deal, then an Endeavor deal. So sometimes these things are contagious, and you'll see activity, but we're pretty bullish about M&A activity across the board.
Okay, Jim, do you agree? And specifically sector specific?
Yeah, the only thing I would add to Dan's comments is, the market environment, meaning corporate spreads, the availability of credit, more comfort in that, the new theme is, maybe rates will have to go higher, but if they do, the view today is it's modestly. So there is a framework for the market. So to the extent that companies need to access the capital markets, the environment is conducive to that today, which I think was much more difficult during a period where rates are rising by 500 basis points. Credit spreads are historically tight. Volatility is relatively low. It'll probably change this afternoon because I'm saying that today. But the general environment, I think, is constructive. And I think if I could hit on one topic that's kind of a corollary, a lot of discussions around private credit, direct lending, versus our businesses. We peacefully coexist is kind of how I look at it. And what's most critical about that existence or coexistence is it allows for creation of credit. And economies, if you look historically, and if you've been a kind of student of macroeconomic policy, you need credit extension for economies to grow. And I think to the extent that this environment remains constructive for that, it's going to be much more constructive for M&A activity and for companies to kind of augment their existing growth relative to the IPO market, which is still bouncing off the lows, but still more concerns around the future growth for those companies and the multiples that they may have to pay, as opposed to acquisitions by other companies to further their existing growth.
So, Secretary, we see two bullish voices here looming in the background, and you hear this in conversation all the time, specifically with this administration, are concerns about regulation. And want to get you to weigh in on whether you agree, or are you as bullish as to the future of M&A and what role Unicon does or does not?
We didn't prepare, but that was exactly the comment that I was going to make when I was listening to this. I was going to say that the big issue is around regulation and what deals can get approved. And, if you look at two obvious areas in both the legacy media space and in the streaming business, there should be a lot of consolidation. And I think in both those areas, there's a lot of regulatory uncertainty. I think also in the tech area, where it used to be pretty easy for big tech companies to buy small tech companies, that's even getting harder. So the whole definition of how you look at regulations, in banking, we're going to look at a major change to capital requirements of the major banks. That's obviously going to have an impact on lending. And you look at the growth of private credit, and really the reason why there's such a big growth of private credit is because firms like both of yours can't, from a capital standpoint, you have plenty of capital and risk. So there's really no issue in terms of the risk, but things that you could take down and then syndicate, from a regulatory standpoint, for capital, you can no longer do. So, I think we're seeing a lot of these things pushed out of the banking sector into private markets, which may or may not make sense longer term.
Jerry, I'm going to leave the last question to you. I'm going to keep my promise. We're going to be to time, so we have 2.5 minutes left. You've been working in Saudi now for 2 decades. A lot of investment happens in, under unforeseen circumstances. So you have a plan, and boom, a war erupts in your region. Give us your sense on the outlook today, not getting too much into geopolitics, but there are plans being discussed, perhaps, of Saudi investment in Gaza. Your take on how the regional picture now, given your vast knowledge and time there, impacts your view on the short-term horizon?
I think people start with getting exposure in the most liquid way possible. So they can manage unforeseen circumstances. If you look at the Tadawul, which is the Saudi Stock Exchange, we achieved MSCI emerging market status in mid-2018. And since that time, the markets, I think the market cap has grown like 5x, 2.8 trillion now. It's the 8th largest exchange globally. Which makes you wonder why it's still emerging market classification. And great returns over the past 3 years, 10 percentage points higher than the S&P 500. And the dividend yield still double that of the S&P. And international investors have already, this is not necessarily news to a lot of people. About 5 years ago, there were 50 qualified foreign investors on the market. Today there's 3,700. And they represent trading volumes that were sub 4% to 17% now. So there's awareness, I think, at that level. The thing that's changing is the ability of the domestic economy to absorb longer-term investment, in large part through the industry building that's happening in Vision 2030. Is creating opportunities for people to come in and partner to capture asset level opportunities as well as top co-investments in some cases. Conflict is very inflationary. It raises risk premiums, and that's something we have to deal with, unfortunately, in our part of the world. But particularly for corporates who are coming in to bring capital alongside a capability, and to capture an opportunity that they see as being part of a longer-term structural trend. A lot of things have happened, and a lot of very healthy conversations are ongoing now.
All right. Well, perfectly to time. Thank you so much. Really interesting
Thank you.
conversation. Thank you all for being here.